Hello everyone and welcome to Financial Accounting. In this video we're going to start talking about Chapter 12, which covers corporations. And in corporations we're going to talk about the organization of corporations, stock and stock transactions, and how they pay back their shareholders or stockholders in the form of dividends. So I think it's a very interesting chapter. Of course we're going to focus mainly on the accounting side of this, but I think it's very useful and helpful. So most large businesses are organized as corporations. If you think about all the big names of publicly traded companies, they're all organized as corporations. And even smaller companies that are not public, they could be still structured as private corporations. So as a result, corporations generate more than 90% of the total business dollars in the United States. And this is true. It's the most profitable structure for any form of business. So corporations, as it says here, 90% of the total dollars generated from businesses is coming from corporations. On the other side, most small businesses are organized as either proprietorships, partnerships, or sometimes we refer to them as limited liability companies or LLCs. A corporation is a legal entity, distinct and separate from the individuals who create and operate it. So I can be an owner in Microsoft without actually doing anything with computers or even softwares or anything related to the company's operations, which is, again, the software business like Microsoft. So how is this possible? Just by simply owning some shares or some stock from Microsoft through the stock market. So as a legal entity, a corporation may acquire, own, and dispose of property in its own name. May also incur liabilities and enter into contracts. So the corporation would have its own legal identity, and they can, again, own assets, they can borrow money under the name of the corporation. So most importantly, it can sell shares of ownership, which we call it stock. These characteristics give corporations the ability to raise large amounts of capital. To continue the discussion of the characteristics of corporation, a stockholder or shareholder who owns the stock owns the corporation. As I said, if I am an owner of few stock for Microsoft, then I'm technically an owner of Microsoft. Stockholders can buy and sell stock without affecting the corporation's operations or continued existence. And then one of the best things about these big corporations is that the transfer of ownership does not affect operations. So I can sell some of my stock to a friend or to someone I don't even know, and the operation of the business is not really impacted because we don't really get involved in the operations. Corporations whose shares of stock are traded in public markets are called public corporations. On the other hand, corporations whose shares are not traded publicly are usually owned by a small group of investors, and these are called non-public or private corporations. The stockholders of a corporation have limited liability, and that's one of the advantages of ownership in corporations, that my personal assets as a shareholder or stockholder are not affected if anything goes wrong with the company. So this means that creditors usually may not go beyond the assets of the corporation to satisfy their claims. So creditors, if they lose, they're going to go and follow the corporation, but corporation assets, but they cannot go beyond that. So the financial loss that a stockholder may suffer is only limited to the amount invested. So the worst I can lose as an investor is the amount I invested in the business. That's not the case for a sole proprietor or even partnerships. If something goes wrong in my business, my personal assets are not protected, but for corporations, my assets are protected. So let's see the organizational structure of a corporation. So we have the stockholders. These are the owners. They select or elect a board of directors, and then the board of directors they hire officers, and then the officers, which are like the CEO and the CFO and any chief financial officer or executive officer. And then the officers are the ones who would hire their employees. And the employees, they deal with the day-to-day operations of the business. So some advantages and disadvantages of the corporate form. Let's focus first on the advantages. So first thing is the separate legal existence. So a corporation exists separately from its owners, and that's a good thing. As a operation side of the corporation is totally different from the owners. Also, one good advantage of corporation is its continuous life. Like a company like Ford still exists, even though the founder of the company is not here. You know, he doesn't live anymore. But so a corporation's life is separate from its owners, therefore it exists indefinitely. So unless something goes wrong in the company itself, in the company's operations, the product is not that attractive anymore. But it's not really limited to the life of the owners. Also, raising a large amount of capital. That's another major advantage. You can bring a lot of capital by selling the stock. So the corporate form is suited for raising a large amount of money from shareholders. Another thing is ownership rights are easily transferable. So you can transfer your ownership from one person to another easily. A corporation sells shares of ownership, which we call it stock. The stockholders of a public company can transfer their shares of stock to other stockholders through stock market, such as the New York Stock Exchange or NASDAQ. And the major advantage is the limited liability. A corporation creditors usually may not go beyond the assets of the corporation to satisfy their claims, as I mentioned before. So the financial loss that a stockholder may suffer is limited to the amount invested, nothing beyond that amount. How about the disadvantages? The first disadvantage is owner is separate from management. So maybe sometimes this is what creates the like slightly conflict of interest, because as a manager, all I care about is my salary, my bonuses, but I don't really care too much about the value of the stock unless there's a motivation for that. So stockholders control management through a board of directors. The board of directors should represent shareholders' interest. However, the board is often more closely tied to management than to shareholders. As a result, the board of directors and management may not always behave in the best interest of stockholders. Of course, that's not always the case, but in a few cases you can see that situation. The other problem with corporations is double taxation. They pay taxes twice. Not the corporation itself, but as an owner of shares in the corporation, I'm actually paying taxes twice. The corporation is paying its own taxes, and then I pay taxes on the distribution of income in the form of dividends whenever it's received. So as a separate legal entity, a corporation is subject to taxation. Therefore, net income distributed as dividends would be taxed once at the corporation level and then again at the individual level. Another disadvantage is the regulatory cost. It's subject to a lot of regulations. So corporations must satisfy many requirements, such as those required by the Sarbanes-Oxley Act of 2002. Now let's talk about forming a corporation. The first step in forming a corporation is to file an application of incorporation with the state. So you go to the state and you file this application. State incorporation laws differ, and corporations often organize in those states with the more favorable laws. Surprisingly, you don't need to file for incorporation in the state where the business is going to be headquartered. The state of Delaware has the most convenient regulations, and that's why half of the largest companies are incorporated in Delaware. After the application for incorporation has been approved, the state grants a charter of articles of incorporation. The articles of incorporation formally create the corporation. The corporation management and board of directors then prepare a set of bylaws, which are the rules and procedures for conducting the corporation affairs. So I want you to remember that the bylaws are like the rules that have to be followed by the corporation. So who set these? It's the board of directors. So the corporate management and the board of directors, they prepare these bylaws. And here we have an example for some of the well-known companies like Alphabet, for Google, Apple, Caterpillar, Delta Airlines. And you see that most of these are incorporated in Delaware. Few of them are incorporated in the states where they have their headquarters. For example, Starbucks. Their headquarters is in Seattle, Washington, and they are incorporated in Washington. For General Electric, or GE, one of the old companies, was actually headquartered in Connecticut, but it's incorporated in New York. So part of the formation of corporation is the cost. And again, as we said before, corporations, to get incorporated, it's a little bit costly process, and you need like assistants, usually lawyers. So costs may be incurred in organizing a corporation. These costs include legal fees, taxes, state incorporation fees, license fees, and promotional costs. Such costs are debited to an expense account entitled Organization Expenses. So we have to simplify by just combining these all expenses in the Organization Expense account. So let's say we have a corporation organizing cost of $8,500. These are going to be recorded by debiting organizational expenses for $8,500, and that's the debit side. Again, expenses are always on the debit. And since we're paying cash, we're going to credit cash for $8,500. And then we have a brief note that says paid cost of organizing the corporation. Now let's talk about something called the paid-in capital, or the paid-in capital from stock. So when a corporation is issued, there are two main sources of stockholders' equity, which are the paid-in capital, or what we refer to as the contributed capital, and the other part is the retained earnings. So contributed capital is what the shareholders bring to the corporation. That's what they invest in the corporation. Retained earnings, as we all know, this is the amount of earnings or net income that has been retained in the business, that's been kept in the business. So the main source of paid-in capital is from issuing stock. Usually that's the main source where we get to record the paid-in capital or the contributed capital. And for retained earnings, the main source is net income. Now let's talk about characteristics of the stock. There are a few terms that we need to know. The first thing is the term authorized. So the authorized is the number of shares of stock that a corporation is allowed or authorized to issue is stated in its charter. And remember, when the company gets listed in the, or gets incorporated, they have to have their charter, and in the charter there has to be an amount authorized to be issued. So let's say we're authorized to issue 100,000 shares. It doesn't mean that we have to issue 100,000. Like, we can go up to 100,000. Most companies, they try to have some kind of safety margin. They would issue maybe only 80,000, and they would keep 20,000 for future growth. So, and of course, in very few cases, we see that companies, they go to the max. Another term is issued. The issued means or refers to the shares actually issued to the stockholders. So these are the, and they have to be something either below the authorized or at most equal to the authorized. We cannot issue more than what we are authorized. A corporation may reacquire some of the stock that it has issued, and we call these the treasury stock, and we'll talk about them later on. And this is why sometimes the outstanding stock might be less than the issued. Why? Because the corporation, when it buys back its own stock, it's not issued anymore. So the outstanding is equal to issued minus the treasury. So the stock remaining in the hand of stockholders is then called outstanding stock. And outstanding is important because these are the stock that would only receive dividends. If we issued stock and we bought it back and they become treasury stock, we cannot really pay dividends to ourselves or the company. But it's only to the outstanding stock that are available by the stockholders. So corporations may issue stock certificate to stockholders to document their ownership. Printed on a stock certificate is the name of the company, the name of the stockholders, and the name of the shares owned. Of course, in today's world, everything is getting to be electronic. In the good old days, everything was on paper. So again, this is the authorized, this is the biggest number, and then we have issued, and then the outstanding. So the difference between the issued and the outstanding is what we call the treasury stock. So let's say the authorized were 100,000, that's what we were authorized to issue. Let's say we issued only 80,000, and then we bought back 10,000, so the left is 70,000, which is our outstanding stock. So the stock certificate may indicate a dollar amount assigned to each share of the stock. We call that the par value. Stock may be issued without par in few cases. Some states allow that, in which case it's called a no par stock. And it's just left to the market to decide the price. And even with par value, that doesn't mean that the price has to be the exact par, like the selling price has to be exactly this par value. Again, it depends on the market. But the par value is like a minimum amount that we want to start with. In some states, the board of directors of a corporation is required to assign something called a stated value to no par stock. So if they don't have a par value, then the board of directors would have to assign a stated value, which is, from accounting perspective, is going to be treated very similar to a par value. So to protect creditors, some states require corporations to maintain a minimum amount of paid-in capital. The minimum amount, called legal capital, usually includes the par or stated value of the shares issued. The major rights the company ownership of a share of stock are as follows. We have the right to vote in matters concerning the corporations, usually major decisions. Also the right to share the distributions of earnings, and the right to shares in assets upon liquidation. So if the company is going through issues and problems, then whatever left over from the assets is going to be distributed among the shareholders equally. These stock rights normally vary with the class of stock. So let me stop here. In the next video, we're going to talk about the different types of stock, which are basically the common stock and the preferred stock.